In this video, we are going to be analysing Bed Bath & Beyond, ticker BBBY. So to get straight into it, firstly, one thing I did want to note, obviously we are 5% on the day, but what's one thing kind of important to note is you can kind of see this is starting to turn much more into a barcodey stock, so it's definitely not got the volume it once did. I mean, if you go on to say a 6-month chart, how has the volume changed? Obviously, this is when we were doing a lot more videos on it, a lot more people were focusing on it when it was in kind of this big move. I mean, actually we can pull this chart to make it even more clear. But obviously, when we had this big move, this is when all the majority of volume was happening, where we had a lot of videos on it. Where was our short bias target, which did end up playing out. But we can see, obviously, volume have declined. A lot of the people holding now are just going to be bag holders. So obviously, be more cautious when trading this, because you're probably not going to see too much profit taking. So if it starts pushing up again, it probably will be quite a steady uptrend until you hit probably $5 and $10 will be areas where you'll see people locking in profits, just because again a lot of these people are going to be bag holders. But anyway, on to more the proper analysis, what we like doing on the technical side using our standard deviation charts. So what we can actually see is firstly, where are our statistical means? So we have one at 217. And we also have the other one at 378. Now this is key to note, this is considered fair value. Now obviously on Bed Bath & Beyond we skyrocketed, it started to crash down, and now we're kind of pushing or staying much lower overall. So yes, you may be thinking, okay, now it's quite cheap if we get a bit of a dead cat bounce, which I mean, a bit late for that now, but if we did, or we just have like some sort of hype move and it starts pushing to the upside, is now a cheap value to get in. And if that is your outlook, then yeah, most probably it is. But the way, if you're looking at it in a more reasonable standpoint and not more of a, if it happens, I want to be in for it, but instead looking at it more as a rational play, within the range of 380 to 215, this is what is considered fair value. Whenever you're buying within this range, it is a gamble. You have no sense of direction. It is basically what you consider, fair value. So it's not overbought, not oversold. So you have no direction really. You could buy in now, but there's nothing saying it won't continue to fall to 215. So buying right now, again, not something I'd be paying any attention to. Instead, I'd be waiting for a move to the up or downside, and that would provide some more trading opportunity. To the downside, I think would be a bit more difficult just because we have no levels. You can see our first deviation, obviously, on the 6-month is at negative $3, and on the 1 year, negative $2. Obviously, we cannot trade into the negative, so that doesn't really help us all that much. So instead, the only way we can look at this to the downside is what are psychological levels. I mean, we have $2, $1.50, $1, 50 cents if we were to push that low, and that's what I'd be paying attention to. But really, it's something I'd be looking to play not to the upside, but if it pushes to the upside, something I would look at more short bias, again probably through the use of options, just because again these stocks can squeeze. I don't want to be trading that naked in any way. So if I was trading it with shorting shares, I would definitely be hedging with some sort of a call option, because again with these kind of stocks, they can run, yes, they'll probably collapse within a week or two, but in that rare chance, like with GameStop, if you started shorting at $15, it still hasn't returned to $15. Yes, it's down very high from its high, but again, it's just depending when you're getting these short entries. If you shorted too early but you weren't protected, that could be a lot of problems. So again, if I was looking at it, it's something I'm looking at more short bias, and where would I turn short bias on it? $8 and above. $8 first deviation on both, first deviation on the 6-month, and then going on to 975, that's our first deviation on the 1 year. This is where I would flip very bearish on it. If we push to this side, getting way over fair value. Fair value now on the high end is near $4. So that's still 100% over fair value according to how I do technical analysis. So at that kind of level, again, that's where I would start shorting. I wouldn't do massive size at that kind of level though, just because again, there is a lot more room for it to move. Considering how it's moved in these 2 previous moves, it can easily move higher. So where would I start building size? That would be at $14 and $15.75. And again, I would always leave a bit of money to add to this position, just because you never know how far it's going to go. I would have a bit more room to go in at $19.80 and kind of $21, and the kind of final portion of my size would be at $26 to $28. Now that's how I would be looking at the stock, again as a short bias play. Probably shorting shares with a hedge of an option, or just playing it straight through either a debit or credit spread, or just outright options depending on how expensive the premiums are. I mean, that's something we can't see now. We have to wait until it moved, and if it does move, how are the premiums? If the premiums are expensive, obviously we're going to be going something through credit spreads and maybe hedging just outright shares with a call option. Otherwise, if premiums are quite cheap, we can look to play the outright or we can look to play the debit spread. Again, it's just going to depend on the environment of the market and how expensive the premiums are. But otherwise, that is kind of our outlook. This is what my main focus would be. Yes, you can get some play to the upside. How would we look at that? So if you kind of break these zones, again, we use them as zones because they're quite close together. But kind of if you broke this zone, for example, of $8 to around $10, you want to see a break to the upside, come back to a retest as a support, and if it can hold, good chance that we're going to push to $14. So again, in that kind of sense, you can make 40%. So there is definitely opportunity to play the upside if you just want to do that. But I don't really tend to do it on these kind of stocks just because, again, they rise a lot slower than they fall. Perfect example here. How long did it take to go? I mean, you had kind of three days of proper movement, and then within 2 days crashed. Again, dead cat bounce. How many days did that kind of move there take? Took 1, 2, 3, 4, 5. If you include that, 6 days, and within 1 day crashed all the way back down. That's why I don't like playing especially these stocks to the upside. I play them more short bias because you can risk a lot less to make a lot more. The only time again I'd be looking to play these to the upside is if you're trading them with options. Obviously, if you're getting calls and you have unlimited upside, if it runs to that $30, yes, you can make a lot of money, but it's whether it's worth the risk to the reward. To me, I feel more comfortable taking it short bias because, again, it's a lot easier to trade. I know it's not going to stay at $30. Well, 99, obviously, you can never be 100% guaranteed, but probability is in my favour. It's not staying at those high levels. If I'm shorting at those kind of levels, high chance or high probability of money to be made. Anyway, that is the breakdown on Bed Bath & Beyond. If you did enjoy the video, why not drop a like and subscribe and check out one of these 2 analysis videos.